8 strategies to secure lower mortgage rate. Interest rates have risen rapidly this year, triggered by the Bank of Canada's efforts to curb inflation. We recently saw the Bank of Canada increase the policy rate by 75 basis points on September the 7th, with the next announcement due on October the 26th. In July, the MNP Consumer Debt Index found that 59% of Canadians are already feeling the effects of these interest rate increases. Why has the impact been so widespread? Well, in part, it has been due to the rising popularity of variable rate mortgages. According to the Canada Mortgage and Housing Corporation, in the latter half of last year, the majority of mortgage borrowers opted for a variable over a fixed rate. Variable mortgages are typically pegged to the lender's prime rate, which means they are immediately affected by changes in the interest rate, whether falling, as we saw during the pandemic, or rising as we are currently experiencing as they are trying to curb inflation. Homeowners with fixed mortgages aren't impacted as quickly because their interest rates are locked in, but they will face higher rates as well when their mortgages are up for renewal. And many homeowners are finding it increasingly difficult to afford or even qualify for a mortgage at today's elevated rates. Fortunately, there are steps that you can take to strengthen your position if you have plans to buy a home or renew an existing mortgage. My name is Evelyn Lopes with the Evelyn Lopes Realty team and iPro Realty, serving the Northwest Toronto GTA. Here are 8 strategies to help you secure the best available rate. And as a bonus, at the end of this video, I will share with you how you can get a free white paper on the 8 strategies to secure a lower interest rate. Number 1, raise your credit score. Borrowers with higher credit scores are viewed as less risky to lenders, so they are offered a lower interest rate in most cases. And a good credit score typically starts at 660 and can move up into the 800s. If you don't know your score, you can access it online from Canada's 2 primary credit bureaus, being Equifax and TransUnion. Then, if your credit score is low, you can take steps to improve it. Over time, you should start to see your credit score climb, which will help you qualify for a lower mortgage rate. Number 2, keep steady employment. If you are preparing to purchase a home, it might not be the best time to make a major career change. Unfortunately, frequent job moves or gaps in your resume could hurt your borrower eligibility. You see, when you apply for a new mortgage, lenders will typically review your employment and income history and look for evidence that you have been financially stable for at least 2 years. If you earned a steady paycheck, you could qualify for a better interest rate. A stable employment history gives lenders more confidence in your ability to repay that loan. That doesn't mean that a job change will automatically disqualify you from purchasing a home, but certain moves like switching from a corporate employment to a freelance or self-employment status could force you to delay your purchase, since lenders will want to see proof of steady long-term earnings. Number 3, lower your debt service ratios. Even with a high credit score and a great job, lenders will be concerned if your debt payments are consuming too much of your income. That's where your debt service ratios will come into play. Now, there are 2 types of debt service ratios. Number 1 is your gross debt service, often referred to as GDS. This ratio speaks to the percentage of your gross monthly income that goes towards covering housing expenses, mortgage, property taxes, utilities, and 50% of any condo maintenance fees. Number 2, the second type of debt service ratio is known as your total debt service ratio, or TDS. Now, this is the percentage of your gross monthly income that goes towards covering all of your debt obligations: housing expenses, credit cards, student loans, car loans, and any other debt that you may have. So what is considered a good debt service ratio? Lenders typically want to see a GDS ratio that's no higher than 32% and a TDS that is 40% or lower. Low debt service ratios will also help you pass a mortgage stress test, which is required by all Canadian banks and some other types of lenders. The stress test is designed to help ensure that you can continue to afford your mortgage payments even if interest rates should rise. You can use the Government of Canada's mortgage qualifier tool to calculate how much you can afford to borrow. I'll put the link down below. If your debt service ratios are too high or you can't pass a mortgage stress test, you may need to consider purchasing a less expensive home, increasing your down payment, or paying down your existing debt. A bump in your monthly income will also help. Number 4, increase your down payment. Minimum down payment requirements vary by loan size and property type, but in some cases you can qualify for a lower mortgage rate if you make a larger down payment. Why do lenders care about the size of your down payment? Because borrowers with significant equity in their homes are less likely to default on their mortgages. That's why you will be required to purchase mortgage default insurance if you put down less than 20%. It's important to note that some lenders offer discount rates for borrowers who put down less than 20%, and this is because the required default insurance protects the lender from any potential loss. However, the cost of CMHC or private mortgage default insurance will typically exceed any interest savings. You will also have to pay interest on that you add it to your mortgage. So the bottom line is you will save money in borrowing costs if you can afford a larger down payment. Fortunately, there are a couple of government-initiated resources designed to help eligible first-time buyers with their down payment for a home. We'd be happy to discuss these and other programs, tax rebates, and incentives that might help you increase your down payment. You can simply scan the QR code shown here to schedule a 20-minute free phone consultation to review your options. Number 5, compare and weigh interest rate options. All mortgages are not created equal, and some may be a better fit than others depending on your priorities and risk tolerance. For starters, there are several interest rate options to choose from. The fixed rate gives you some protection if rates go up, while the variable offers some benefit if rates fall. So what's the best choice if you're looking for the lowest mortgage rate? The answer is, it depends. If mortgage rates don't rise much higher or drop back down in a couple of years, you could win by opting for a variable rate. However, if they continue to climb, you may be better off with a fixed rate. The best plan of action in selecting a mortgage is to speak to your mortgage lending professional. If you would like some recommendations to some great lenders, feel free to reach out to us and we'll be happy to share. Number 6, compare loan terms. A mortgage term is the length of time your mortgage agreement is in effect. At the end of the term, a mortgage holder will need you to either pay off the mortgage or renew it for another term. There are 3 major types of mortgage terms. Shorter term, these can range from 6 months to 5 years, and they are the most popular type in Canada. Borrowers can choose between a fixed or variable interest rate. Longer term, these are longer than 5 years, but generally no more than 10 years in length. Longer-term mortgages are more likely to feature fixed interest rates and hefty prepayment penalties. Convertible mortgages offer the option to extend a shorter-term mortgage to a longer-term mortgage, typically at a different interest rate. Which loan term offers the lowest rate? A shorter-term mortgage will typically feature a lower interest rate than a longer-term mortgage. However, the rate on a 1-year or a 3-year mortgage could be higher or lower than a 5-year mortgage depending on the current economic climate and whether it's fixed or variable. But to find the best rate, you need to compare your options at the time of purchase or renewal. A good lender will also review your situation and your future plans, which may also impact the type of mortgage term that would best suit your scenario. Number 7, get quotes from multiple lenders. When shopping for a mortgage, be sure to solicit quotes from several different lenders and lending types to compare interest rates, fees, but also prepayment privileges and other options within the mortgage, such as skipping or doubling up on payments. Depending on your situation, you could find that one institution offers a better deal overall in terms of the type of loan and term length you want. Ideally, you should begin this process before before you start looking for a home. If you get pre-approved for a mortgage, in most cases, you can lock in the mortgage rate for 90 to 120 days, depending on the institution. And this is especially important when interest rates are rising. Don't forget that we can be a valuable resource in finding a lender, especially if you are new to the home buying process. After a consultation, we can discuss your financing needs and connect you with a loan specialist or broker best suited to your situation. Number 8, ask for a discount. When shopping for a mortgage, don't be afraid to negotiate. In Canada, it's commonplace for the lenders to discount their advertised interest rates, which are called posted rates. And in many cases, all you have to do is ask. Of course, the strength of your application will come into play here, so don't neglect strategies 1 through 4 that we discussed. Here is a pro tip. Keep in mind that interest rates aren't the only thing on the table. You can negotiate other contract terms as well, like prepayment options and rebates. And if you get a great offer from one lender, you can leverage it by asking your preferred institution to match or beat it. Getting started. Unfortunately, the rock bottom mortgage rates we saw during the height of the pandemic are behind us. However, today's 5-year fixed rates still fall beneath the historic average and are well below the all-time peak of 20.75% that we saw back in 1981. And although higher mortgage rates have made it more expensive to finance a home purchase, they have also ushered in a more balanced market. Consequently, as a home buyer today, there are benefits you will have. A greater selection of homes to choose from. You will have the ability to perform your due diligence in terms of conditions such as financing and home inspection, and you will have the ability to negotiate terms with sellers and obtain better value for your investment. For a white paper summary of these tips, simply click on the link below. If you have any questions or would like more information about the buying or selling of a home, reach out and schedule a free consultation. We'd love to help you weigh your options, navigate this shifting market, and reach your real estate goals. Again, my name is Evelyn Lopes with the Evelyn Lopes Realty team and iPro Realty, and we're here to help.